My name is Garrett Monroe. I'm the Sell-Side Director at Calder Capital. I am joined today with Ryan McCaslin, the Transaction Advisory Services Partner over at EHTC. Today's topic is going to be centered around quality of earnings, specifically why sellers should be thinking about ordering a quality of earnings or conducting a quality of earnings before you go to market as a resource to prep, make sure that the financials are rock solid, and to make sure we can get out in front of questions for buyers. So I'm excited that Ryan's able to join us today. Similar to past videos, we're going to rock and roll with a Q&A format. So the first question that I have for Ryan today is, what exactly is a quality of earnings report, and how does it differ from a company's standard financial statements? And from your perspective, why is a quality of earnings important for a business owner preparing to sell?
Well, thanks for having me, Garrett. Appreciate it. So a quality of earnings really is a deep dive into the financial and operational aspects of a company. Main focus is coming up with an adjusted EBITDA or adjusted earnings number for Garrett and his team to be able to present that to buyers before going to market. And the reason that's important is most buyers will apply a multiple of EBITDA to a company based on a variety of factors to come up with their business valuation for the company. So very important that that's done so buyers can make more informed offers before they present those to Garrett and his team. As far as the financial statements go, we see a lot of financial statements from companies that are not audited or reviewed and have never had any third-party accounting support, and their financial statements as is would not go against the scrutiny of a buyer. So there's several things that we can do there. Transfer to cash to accrual accounting. Sometimes people are not counting their inventory, helping them with that. Another thing that we do is called a proof of cash. So although there's no third-party accounting support, we can take third-party bank statements and reconcile those within reason to reported income and expenses to be able to say, hey, there's no outside audit, but we have a third-party source that can give you a little bit of comfort that the reported revenues and incomes that they're presenting to you are fair. I guess on the audit side, we also hear sometimes, well, we don't need a quality of earnings because we already have an audit. They're two completely different products. An audit has a level of materiality, so there may be some adjustments that an auditor may not record because it just doesn't make sense for the purposes of the audit. But when you start talking about those EBITDA multiples, those adjustments can be really beneficial to the valuation. Also, audits really focus heavily on the balance sheet. As long as the balance sheet's correct, the income statement's correct, which is factually true. Although an audit doesn't care about non-recurring items that may be flowing through the income statement that could affect your EBITDA and your valuation as well.
Well said. Yeah, so big picture to tie the two together. Ryan's team does a great job of making sure the earnings, which we want it to be as high as possible, which is going to help increase the valuation for our sellers. His team's job is to make sure it's as bulletproof as possible before we head to market so buyers can have more certainty. The second question I have for Ryan is, how does a quality of earnings affect negotiations and buyer confidence in a deal?
Sure. So buyers love to see quality financial information and buttoned-up reporting. We're talking about a manufacturing company, customer profitability, product profitability, everything lined up and ready to go, being able to prove their value to a buyer. It also, if you do a QofE before going to market, it really puts kind of you as a business owner and Garrett and his team in the driver's seat, because there might be 5 or 6 potential buyers out there. The quality of earnings has already been done. So Garrett's going to say, hey, you can confirm the QofE with EHTC and have some time with management, but they're not going to allow a buyer to have 3 or 4 weeks of your time. The work's already been done. You can confirm it. You're not going to kind of go in and do an exploration exercise that's already been done. So it kind of really puts the power in your hands.
That's really well said too. Yeah, so Ryan's team's a third party. So if he's able to validate it and they're able to talk with the buyers, talk about the work that they did, it definitely gives the financials more credibility than if we were to be the only ones in the room saying that the financials are quality financials. The third question I have, and last question for Ryan, is if you could give one piece of advice to a business owner who's never heard of a quality of earnings before, what would it be?
Sure. So I think business owners really underestimate the amount of time and effort it takes to sell a company and how difficult diligence can be. Not only do you have financial QofE diligence, you have tax, operations, sometimes IT, human resources. So you got a bunch of different groups coming at you at once. So being prepared at any given point in time, even if you're not even considering selling, is just good business practice, right? And having everything, and it helps you run your business better, right? So like, for example, are you raising your customer prices when you should be? Sometimes a business owner doesn't even really look at that. They have money coming in and they don't think about those kind of things. So it really takes a lot of time and effort to sell a business. And I'm sure Garrett can attest to this as well. Sometimes business owners get so caught up in the diligence because they're not prepared that the company starts to suffer and the profitability starts to suffer. Then those buyers start looking at the numbers and they're like, well, wait a second, you're trending downwards, when in reality, it may just partially be a function of you taking your eye off the business. So it's really important to be prepared at any given point in time.
That's a great point. Yeah, I mean, it requires a team. We've had some other people join the videos. We've had financial advisors, we've had attorneys. Ryan's team makes sure that as we go throughout the process, the financials are positioned in a way that buyers can easily digest, not just the buyers themselves, their lenders, investors, et cetera, that are supporting them throughout the transaction. Hopefully you found this video helpful. I know quality of earnings are talked about a little bit, but also Ryan's team, that's all that they do. So hopefully if you have any questions, Ryan and his team would be happy to be able to answer those. And we also at Calder Capital look forward to working with sellers in tandem with folks like Ryan and his team. Thanks for joining us. If you enjoy learning more about Calder Capital and our sell-side advisory practice, you can contact or find us on the details listed on the screen. We look forward to hearing from you soon.